Welcome, our financial detectives. Have you ever looked at a company's balance sheet and wondered, are these numbers actually telling the whole truth? Well, today we are bringing you a fascinating explainer where we're going to learn how to perform a rigorous health check on financial statements. We're uncovering the actual mechanics of IAS 36. That's the accounting standard specifically designed to ensure a company's balance sheet isn't hiding any sick or overvalued assets. Let's get right into it.
Okay, so here's our roadmap for today. We'll follow the impairment life cycle step by step. First, the core objective, then spotting the warning signs, calculating recoverable amount, diving into the complex world of cash-generating units and goodwill, and finally, recognizing and reversing those losses.
Let's kick things off with part 1, the core objective, the health check.
Now, this standard exists for one huge reason, to act as a mandatory reality check for a company's books. Let's define our main culprit here, impairment. Basically, impairment happens the exact moment an asset is revealed to be worth less than what's actually recorded. When the carrying amount, that number just sitting there on the balance sheet, is higher than the cash you could realistically recover from either using or selling the asset, well, you've got an impaired asset on your hands.
And this really brilliantly illustrates the core balancing act we have to perform as financial detectives. On one side of the scale, you've got the carrying amount. That's the asset's original cost minus its accumulated depreciation. On the other side, you have the recoverable amount, which is its actual real-world value today. If the scale tips, right, and the carrying amount is heavier, the standard absolutely requires the entity to step in and recognize an impairment loss immediately, no sweeping it under the rug.
Moving on to Section 2, spotting the warning signs, the detective's clues.
So how do we actually know an asset is in trouble? We don't just run these tests blindly. Entities have to check their sort of detective's dashboard for clues at the end of every single reporting period. Externally, we are looking for things like major market crashes, maybe obsolete tech, or rising interest rates. Internally, we're keeping an eye out for physical damage, major restructuring plans, or internal reports that show the asset is just totally failing its budget.
Consider how we treat a specific real-world clue. Imagine a factory machine that has suffered some serious physical damage. It still operates, but way less efficiently. Management can't just ignore the issue because the machine still technically turns on. That damage is a huge trigger. It prompts an immediate, deep-dive investigation into what its true recoverable amount actually is.
Which brings us right to Section 3, calculating recoverable amount, weighing the evidence.
Right, so once we spot a warning sign, we've got to pull out our tools and calculate what the asset is actually worth. To find this recoverable amount, we must find the higher of two very specific values. First, we look at fair value less cost of disposal, meaning what could we literally sell it for today minus any legal or removal fees. Second, we look at value in use, which is the present value of all the future cash flows we expect to squeeze out of it by keeping it running. Whichever number is higher wins.
Now, when calculating that value in use, IAS 36 sets up some extremely strict guardrails to prevent management from being, let's say, overly optimistic. We strictly base future cash flow projections on management's most recent budgets, and generally, these only project out to a maximum of 5 years. And more importantly, we assess the asset in its current condition. That means we are explicitly ignoring any potential benefits from future restructurings or fancy enhancements that the company hasn't actually committed to yet.
Let's jump over to Section 4, cash-generating units and goodwill, solving complex cases.
But wait, what happens if an asset doesn't generate cash entirely on its own? You can't always isolate the value of a single gear inside a massive clock, right? This brings us to what I like to call the Russian doll concept of accounting, the cash-generating unit, or CGU. When we can't estimate the value for one single asset, we zoom out. A CGU is simply the smallest identifiable group of assets that generates largely independent cash inflows.
Let me give you a perfect example straight from the source. Consider a mining company that owns a private railway solely to support its mining operations. On its own, that railway doesn't generate independent revenue. Honestly, it could probably only be sold for scrap. So, because its value in use is literally impossible to determine separately, we zoom out. We group the railway into the mine's overall cash-generating unit to properly test it for impairment. Makes sense, right? Or take a municipal bus company that's mandated by contract to run 5 specific routes. Let's say 4 of those routes are highly profitable, but 1 operates at a massive loss. Because the company doesn't actually have the option to just shut down that losing route, the individual routes can't be separated. Therefore, the entire 5-route network becomes our single cash-generating unit for impairment testing.
Now, testing a CGU can get mathematically tricky. Imagine a mine that's required by law to completely restore the land after it closes. The company has already recognized a 500 currency unit liability for this future cleanup. This burden is permanently attached to the mine. Any potential buyer would be forced to take it on. It's totally inescapable baggage.
So, to make a fair apples-to-apples comparison, we actually have to deduct that 500-unit liability from both the carrying amount and the calculated value in use. You simply cannot ignore recognized liabilities if a buyer is permanently chained to them. It would totally skew the math.
Now, nestled within these CGUs, we often find goodwill. That's the premium paid during a business acquisition. Goodwill doesn't generate separate cash flow, so it gets allocated to the CGUs that actually benefit from the acquisition synergies. But here's the real kicker. Unlike a physical piece of machinery, goodwill and intangible assets with indefinite useful lives don't actually need a warning sign to trigger a test. IAS 36 absolutely demands they be tested for impairment annually without fail.
All right, Section 5, Recognizing and Reversing Losses, Closing the Case.
So, once we absolutely confirm the carrying amount exceeds the recoverable amount, it's time to face the music and update the books. If we're dealing with a whole CGU, we use a very strict execution playbook. Step 1, goodwill takes the very first hit. You reduce any allocated goodwill completely down to 0. Step 2, if there is still a loss left over, it gets distributed proportionally, or pro rata, to all the other assets in the unit based on their carrying amounts.
However, our rules state there is a hard floor. When you're allocating that loss among the assets, you can never, ever reduce an individual asset's carrying amount below the highest of 3 things: its measurable fair value less costs of disposal, its determinable value in use, or simply 0. You can't artificially create a negative asset value just to absorb a CGU's massive impairment loss. That's a huge no-no.
But hey, accounting isn't always all doom and gloom. Later on, at the end of subsequent reporting periods, we check our dashboard again. If the economic environment improves, say, market values suddenly surge, interest rates drop, or the asset's performance just dramatically exceeds expectations, we assess if a past impairment loss can actually be reversed. If the recoverable amount has gone back up due to a change in estimates, we can increase the asset's value back up. But, importantly, it's capped at what its carrying amount would have been had it never been impaired in the first place.
But here's the ultimate golden rule, clearly stated in paragraph 124 of the standard. An impairment loss recognized for goodwill shall not be reversed in a subsequent period. If goodwill takes a hit, it is permanent, a hard stop. Why? Because any subsequent increase in the recoverable amount of goodwill is highly likely to be internally generated goodwill rather than a reversal of the acquired goodwill we originally impaired. You just can't write it back up. So as we wrap up this explainer, I want you to think about the financial data you rely on every single day. Impairment isn't just some boring accounting technicality. It's a mirror reflecting genuine economic reality. Take a look at your own financial statements, or maybe those of the companies you invest in. Are they diligently investigating their assets? Or are there hidden ghosts of impaired assets past just waiting to be discovered? Keep that detective magnifying glass close.